Mr. Bhuta, welcome at NDTV Profit, and always pleasure to have you. Talking about, let's just start with the margin. What's the outlook when it comes to EBITDA margin? Because it has come off. Is it the reason because you have ventured into interior or furniture business, and that has led to the decrease in margin over the few quarters? What's the outlook when it comes to EBITDA margin? What should investors expect?
Oh, thank you very much for inviting me on the call. Certainly, the margins are improving if you see on a PAT level, particularly because the leasing business, we believe it will be a better indicator to look at the EBIT or the PAT as a margin indicator. And if you look at it from the PAT level, if you see the quarter on quarter, it has increased relatively under all the verticals, whether it is design and build, whether it is leasing, and whether it is the furniture manufacturing. So overall, I think not just the revenue, but the PAT margins have also gone up. And that's a strong side for us as an organization going forward, yeah.
I believe your capacity utilization continues to remain at around 90% odd.
Absolutely, and that is one of the key, and that's what we intend to maintain always. Because in the leasing business, these are some of the key areas that we need to really focus on. One is obviously to maintain the occupancy, because otherwise that kind of hits you back in your margins. If you're not able to kind of keep your all real estate leased area completely leased out and revenue generating, then obviously the cost hits you back and your margins would obviously get narrowed down.
Right. So, sir, since you said that you give preference to the PAT margin, what should investors expect when it comes to revenue growth for next 2 years and PAT growth for next 2 years, considering the increasing PAT margin as well?
So, please understand that both my leasing business and the design and build business have matured well, where both of them have been doing consistently well since last about 8 to 10 quarters. Leasing business, as you know, that we've been always maintaining that on an annual basis, we'll be adding about 20,000 plus seats of about 1 million square feet to our total portfolio. So that will kind of help us increase our top line consistently, because leasing is primarily an annuity business, and our margin there remains roughly around 30% plus on a normalized basis. While on the design and build division, we are expecting to grow around 50 to 60% year on year. In fact, if you see my 9 months results, 9 months previous year to this year, we have grown by 76%. But we certainly kind of intend to grow and expect to grow in anything around 50 to 60% YOY under the design and build business, and where the margins also remain fairly stable around 20 to 24% on a PAT level. And then I'm looking at the furniture manufacturing business. That is a division which is just about a year old, and it will take another 6 months to 9 months to stabilize, where then I will be able to kind of come in more specifically in terms of the stabilized margin, because then the capacity utilization would be at its optimal. But overall, even in the furniture business, we are expecting that at an optimal level, we should certainly be able to make an kind of an EBITDA of 25% or a kind of a PAT of anything around 18 to 20%.
The furniture segment, as you were mentioning, it's a new segment. I believe it contributes around 3 to 5% to your top line. Say 1 year down the line, how much do you expect this segment to contribute? And as you were mentioning that it will take around 6 months odd to stabilize, which means that in the next 6 months, will this segment be EBITDA break-even?
Yes, 100%. And it is already at an EBITDA break-even. But what will happen is that the growth will come in, and we are expecting this division to really kind of touch, do the, like I said, the total expansion complete by about 6 to 9 months time, where we'll be at a capacity of around 75 to 80%. And with that, this division would kind of contribute roughly around 10% plus to the total revenue mix on a consolidated level.
Right. And sir, the average rent per seat is at rupees 7,000 to 7,300, if I'm not wrong. Now, as you scale up, are you anticipating any pressure when it comes to these realizations or no?
No, I mean, please understand we are already at a most, reasonable number when it comes to the average rental because, we operate at a price which is the sweet spot where, we generally operate anything around today at the best pricing that we operate around 7 to 8,000 rupee per seat. And I think that is the best kind of target that one can look at to capture the maximum catchment that you can kind of cover for the entire ecosystem that is available under our flex office model. So we believe that the pressure on the pricing would not be that significant considering the level at which we operate already. And we are very confident to maintain these price levels going forward, certainly.
Right. Just wanted to understand one thing. In the third quarter, how many new properties you have added? In Q4, how many do you plan to add? And any plans that you have made for FY27 as well?
Yes, obviously, this inventory build-up is a process, and you will have to build it up, 6 months, 9 months, or in advance. So obviously, this particular the Q3 which we are referring to, we've added about more than 4 properties in Q4 in Q3, and under Q4 we will be adding another about 4 to 5 properties which will become live and operational. And obviously, we already have a visibility of over 10,000 seats, which is about a 500,000 square feet for next financial year as well.
I think most of your capacity is in West, if I'm not wrong. Any plans to diversify into North and South markets?
No, it's just that this particular quarter, Q3, kind of we did all our new centers, majority came in West. But, across, otherwise, we are expanding very heavily in the northern market, which is the NCR region. Also in the southern market, which is Hyderabad, Bangalore, and Chennai market. And we are, kind of truly becoming that pan-India player who can really have the presence, not just in the West, but also East and North, and also in South equally. So, I mean, going forward, we strongly believe that the ratio will evenize and we should be able to kind of maintain a very strong presence both under West, North, and also under the Southern and the Eastern market.
Right. And also onto your design and build business, what's the current order book size and what's the execution timelines?
We are already at more than 160 crore order book for the Q4 that we are now presently working on. And the deliveries are also pretty much online. We are expecting out of the entire order book at least to, kind of contribute about 70-75% them off during the, recording the revenue from this order book during this Q4 financial of FY26. So, and going forward also, we have got greater visibility for the upcoming financial year. And hence, we are able to, kind of project, kind of growth of anything around 50% minimum to my top line for the design and build division.
Right. And lastly, sir, just wanted to check, given the fact that you have such expansion plans, I know I asked you this question last time as well, but again, do you have any plans to raise funds?
I mean, obviously, raising capital is a process of expansion, and we are looking at kind of expanding continuously. We are looking at kind of meeting our capital requirement judicially. We are looking at different sources of capital that can adequately, maintain our profitability and also value to the shareholders. So we'll certainly come back to the street as soon as we kind of, make our plans relating to that. But we are actively pursuing the expansion strategy. We are actively pursuing kind of growing our all the 3 verticals, and we are very positive and kind of very strong parameters are working towards the achieving those growth that we are targeting.